Today, we will discuss the intricacies and nuances of moving an entity taxed under Subchapter S of the Internal Revenue Code, which may be an LLC, partnership, or corporation, and which is sometimes referred to as a Subchapter S corporation or Sub S entity, to a new state without paying taxes for the move and while keeping the same federal employer identification number, contracts, business credit history, and in most cases, the business name. My name is Chad Cummings, and I am an attorney and certified public accountant serving clients in matters of business, tax, and commercial law throughout the great states of Florida and Texas. I am Chief Executive Officer of the law firm Cummings and Cummings Law. I also teach business law at the university level, and I hold 4 degrees, including 2 law degrees, together with a variety of tax, financial, and accounting credentials, which I apply for the benefit of my clients in my practice of law. Our firm website is www.cummings.law. The S corporation is one of the most tax-sensitive business structures in the United States, and it is uniquely vulnerable to destruction when an owner tries to move the company across state lines without fully understanding the underlying legal mechanics. Every year, small business owners inadvertently terminate their S corporation elections, trigger taxable liquidations, and lose years of built up shareholder bases simply because they decided to take matters into their own hands rather than relying on an experienced and competent attorney and CPA and filed the wrong form. The IRS treats state chartered entities as legal persons. When you deserve, merge, or reincorporate without undergoing the redomestication process, you do not move that person, you kill it and create a new one, a zombie. For an S corporation, that act can be terminal. The federal election is extinguished, the federal employer identification number is terminated, and the tax attributes are trapped in a corpse that no longer exists. The heart of the problem lies in misunderstanding how fragile an S election really is. Under Internal Revenue Code sections 1361 and 1362, an S corporation's election attaches to a single legal entity identified by a specific employer identification number. The election does not follow the owners, the officers, or even the business name. It follows that entity's distinct legal existence. When a company organized under Delaware or Texas law, or the law of another state, dissolves, that dissolution is in most cases permanent. And when a new entity is organized in a new state, the IRS sees 2 distinct taxpayers, even if every shareholder and every officer is identical. The old entity must file a final return on Form 1120-S, reporting all income through the date of dissolution, and the new entity must apply for a new federal employer identification number and may not be eligible for immediate S election status, depending upon its capitalization and shareholder structure. The owner mistakenly believes that all he has to do is change the address. But in the eyes of the IRS, he has liquidated and terminated a corporation and formed a new corporation. This administrative misstep can carry massive tax consequences. A liquidation under Internal Revenue Code Section 331 or 336 treats all appreciated assets, for example, real estate, goodwill, equipment, and intellectual property, as being sold at fair market value. The corporation in turn recognizes gain, and shareholders recognize income again when those assets are distributed. Because most small businesses hold intangible goodwill far exceeding book value, that so-called phantom sale can generate a 6-figure tax bill or larger. The owner never actually sold anything, and yet the IRS is now knocking on the door with their hand out for a payment. State taxing authorities will soon follow suit, assessing corporate and franchise taxes on the same event. Once this occurs, there is usually no way to reverse the treatment. The IRS cannot simply revive a dead S election or reinstate a terminated federal employer identification number for an entity that legally no longer exists. Another trap arises when a business owner forms a new corporation and merges the old company into it, believing that this somehow preserves the continuity. Big mistake. In reality, the merger merely designates one company as the survivor and dissolves and terminates the other. If the new entity survives, the IRS treats it as a new taxpayer with a new federal employer identification number, requiring a new subchapter S election. If the old out of state corporation survives, then nothing is actually moved. The company is still domiciled under the prior state's law and must continue filing and paying taxes there. Mergers can sometimes qualify as a tax-free reorganization under Internal Revenue Code Section 368A and other relevant code sections, but those are designed for multi-party acquisitions, not usually state relocations. The procedural complexity, valuation requirements, and shareholder-level filings make merger an impractical and very risky tool for small and even medium-sized business owners. Even when the paperwork appears correct, the IRS can classify the surviving corporation as a new entity for EIN and election purposes, undoing the intended benefit. Foreign entity registration, which I have also addressed in my earlier presentations, creates a different but equally costly problem. Many CPAs and even some attorneys incorrectly advise their clients to simply register their out-of-state S corporation in the new state as a foreign corporation. On paper, this sounds very simple, and I'm sorry to say it's really not. While this does allow the company to conduct business in the new state, it does not change the state of domicile. The entity remains governed by and taxable in the original state. That means 2 annual reports, 2 registered agents, and 2 layers and levels of franchise taxes and filing fees. Whereas the company remains under the jurisdiction of the foreign state's corporate law, which may have stricter and less favorable shareholder rules, broader veil-piercing standards, and less favorable indemnification provisions. The owner mistakenly believes that he has moved his business to a new state. He is not, because legally he is still operating under the regime of the old state and paying double for the privilege. The best solution in most cases, and certainly the most tax-favorable approach to relocate an S corporation to a new state while preserving the federal employer identification number and election, is through redomestication, which is sometimes called conversion, continuance, or statutory conversion. Redomestication is a unique legal process available in states like Florida, Texas, and a few others, allowing an existing corporation to change its jurisdiction of organization without dissolving. Now, let me clarify. When I say redomestication is available in Florida, Texas, and a few other states, what I mean is that states like Florida and Texas make it easy to redomesticate to those states being the new states. We are able, in most cases, to conduct a redomestication from virtually any other state in the union using a variety of legal, ethical, yet creative approaches. The entity under the redomestication process continues as the same legal person. That is very important. We are not dissolving the entity. We are not terminating the entity. Rather, only the governing law and principal office will change. When performed correctly, it is treated by the Federal Internal Revenue Service as a non-taxable and non-recognition event. There is no new federal employer identification number, no deemed liquidation, and no change in shareholder basis or accumulated adjustments account balances. The business continues filing under the same S election as if it had always been at home in the new state. Preserving that federal employer identification number is crucial because every piece of the company's administrative, operational, and financial life is tied to it. Payroll systems, electronic federal tax payment accounts, W 2 and 1099 filings, and state withholding registrations all use the federal employer identification number as the unique identifier. When the number changes, those systems no longer reconcile. Payroll deposits go uncredited, wage reports will flag as a mismatch, and the IRS begins asking questions. Banks, insurers, and merchant processors also rely on the federal employer identification number for identity verification. A change in the federal employer identification number can trigger undesirable anti-fraud freezes, suspended deposits, and mandatory re-underwriting. Commercial credit bureaus such as Dun and Bradstreet and Experian will close the old credit file permanently and start a new one, potentially wiping years of positive payment history off the books. Losing that unique numeric and legal identity sets your business back to zero in most meaningful ways. The problem compounds for S corporations because their unique tax characteristics depend upon this continuity, which is lost. The accumulated adjustments account, or AAA, which tracks previously taxed but undistributed income, belongs to the specific taxpayer holding the S election. When that entity ceases, which can happen when a business owner takes the law into their own hands and tries to move their S corporation to a new state without the experience of an attorney to assist them, the AAA disappears. Distributions from the new entity will be taxed again as dividends, even though the underlying income was already taxed once. Shareholder stock basis, which determines whether future distributions are taxable, also resets to zero. A single mistake in filing can therefore cause double taxation on every future dividend until the basis is rebuilt, often resulting in years of unnecessary taxation. Now, let me be very clear. A properly executed redomestication, which is distinct from merger and foreign entity qualification and also distinct from dissolution, avoids all of these pitfalls that I am describing. The entity files a plan of conversion approved by its shareholders, then submits articles of conversion and articles of incorporation to the new state. Simultaneously, or I should say more precisely, following the approval of those documents by the new state, it will file corresponding conversion documents with the original state to withdraw and convert out as a former domestic entity. But it is not dissolved, and that is the key point. The end result is a continuous, unbroken legal existence under the law. The IRS and state tax authorities see no interruption. The federal employer identification number remains valid and intact. Payroll and withholding accounts stay open, and all contracts, licenses, and insurance policies will remain in force. From the outside, nothing changes except the state listed on your charter. Now, attempting to perform this nuanced and complicated process without professional guidance is particularly dangerous and short-sighted. Each state's statutes specify unique sequencing and language requirements, and the terminology is often quite different across state lines. Filing in the wrong order, such as dissolving the entity before filing the appropriate conversion documents in the new state, destroys that continuity and creates that dreaded taxable liquidation. Omitting the plan of conversion or failing to adopt it by formal consent violates statutory prerequisites and may render the filing and everything that comes after the filing void. Some states require certified copies, although most do not. A licensed attorney experienced in multi-state redomestication understands how to coordinate both sides to ensure legal and tax continuity and harmony. From the perspective of the IRS, the distinction between redomestication and dissolution or merger or foreign entity registration is everything. The IRS does not care about the intent or the goodwill or the good faith of the business, the marketing materials, or how you spin it. It cares only about the legal existence of the taxpayer associated with that particular federal employer identification number. Redomestication is the only transaction of this nature that preserves that existence and continuity. The business remains the same taxpayer, merely under a different state's law, so that the federal employer identification number, the S election, and all related accounts and contracts remain intact. Every other approach that I've talked about, dissolution, merger, or foreign entity registration, either kills the entity or creates a duplicate, breaking that ever important chain of continuity. In practical terms, preserving the S election and federal employer identification number through redomestication saves not only taxes, but reputation. Vendors continue to see the same entity on their W-9 forms. Banks see the same taxpayer on record. State licensing boards recognize the same license holder. Payroll services, merchant processors, and lenders all continue to operate with your business seamlessly. Your company's legal, financial, and operational identity remains whole and intact. You have truly moved your business, which is presumably what you were trying to do, instead of destroying and replacing it with a zombie entity. The bottom line is that for entities taxed under Subchapter S of the Federal Internal Revenue Code, continuity equals survival. Once the federal employer identification number and election are lost, they cannot be easily resurrected. The IRS will not simply transfer them to the new entity. Reapplying for S status requires new filings, new waiting periods in some cases, and potential new exposure to double taxation. Shareholder basis, credit history, and corporate credibility vanish. The cost to fix the mistake routinely exceeds the cost of doing it right in the first place many times over. I'll just tell you as an aside, when we are brought in to perform cleanup work because somebody took the DIY approach and lost their election, we're looking at a minimum $25,000 retainer. Redomestication is the only method that preserves the S corporation's legal and tax identity. Moving your business to a new state can be a powerful strategic decision, but only if executed with precision. This is not the time to try the do-it-yourself approach. A properly handled redomestication, prepared and filed by a licensed attorney and CPA working together, protects your federal employer identification number, S election, and your hard-earned reputation. Anything less is simply gambling with the legal heartbeat of your company. Again, my name is Chad Cummings, and I hope that you found this information helpful. As always, the information in this presentation is general in nature and is not legal advice, because legal advice, by definition, must be specific to a particular set of facts and circumstances. Should you have any questions regarding this information or the content of any of my earlier presentations, please visit my firm website at www.cummings.law, not .com, but .law, to schedule time for a consultation. I look forward to the opportunity to speak with and perhaps even work with you very soon.